Inheritance tax can be a daunting topic. There's a way to pass on unlimited sums to your heirs without paying any inheritance tax. The gifts out of surplus income rules allow families to give away as much as they want during their lifetime. It's one of the best ways to bring the value of your estate below the tax-free allowance and sidestep death duties. Inheritance tax is charged at 40% on estates worth more than £325,000. But married couples and civil partners can get a combined allowance of up to £1 million. To qualify for the exemption, the gifts must form part of a pattern, come out of income, not capital, and should not diminish the donor's standard of living. Applying this in practice can be far from straightforward. It's important to understand inheritance tax and plan accordingly. Otherwise, you could end up paying more than necessary. Don't let that happen to you. Inheritance tax can be a tricky subject, and the rules around it can be complex. His Majesty's Revenue and Customs has provided detailed guidance on how its officers should interpret the rules. However, these interpretations can sometimes appear bizarre and arbitrary. For example, the taxman will look at the donor's annual income to work out whether they could afford the gifts, but income held for more than 2 years will generally be considered capital. It's important to understand the rules to avoid unexpected tax bills. For example, if you gift a property to your children, it could be subject to inheritance tax if you don't survive for 7 years after the gift. So, it's important to seek professional advice and plan ahead to minimize your inheritance tax liability. Don't let the taxman make bizarre and arbitrary decisions about your estate. Let's discuss how you can take advantage of the exemption. The exemption can cover income from various sources. It's possible that your mother may be able to take advantage of the exemption, depending on the assets that make up her estate, as an example. Gifts out of surplus income can qualify for the exemption. However, the gift must have been made out of income and must form part of your normal expenditure. For example, purchasing a car may qualify for the exemption if it was purchased using income specifically to give to the recipient. Remember, it's important to seek professional advice to ensure that you take advantage of the exemption correctly. To qualify for the exemption, it's crucial to keep detailed records of all gifts, including intended future gifts. Maintaining a consistent gifting pattern is key. In some cases, only a portion of the gift will be exempt and the remainder will not qualify. However, gifts for specific costs, such as school fees, may still be eligible for the exemption. It's important to note that the exemption only applies to inheritance tax. If income or capital is disposed of to avoid care home costs, the local authority may transfer the liability to the recipient. Remember, taking the whole pension commencement lump sum at once will not avoid other taxes. Keep detailed records to ensure eligibility for the exemption. Anything that isn't exempt due to personal allowances would be subject to income tax. But there are ways to mitigate inheritance tax through gifting. Gifts can be made directly to individuals or put into a trust for minors. It's important to consider the £3,000 annual exemption and the potential for chargeable lifetime transfers. It's worth noting that gifts of income may have suffered income tax. Recipients may also pay tax on any income that arises from the gift, such as bank interest. Remember, proper planning can save you and your loved ones a lot of money. Just a quick reminder before we proceed. Please remember to hit the like button. Also remember to subscribe to the channel and hit the bell button so you get all the notifications about upcoming videos. Navigating the intricacies of inheritance tax can be akin to traversing a labyrinth fraught with complexities and potential pitfalls. While many individuals seek to minimize their tax liabilities and preserve their wealth for future generations, the ever-evolving landscape of tax laws presents a formidable challenge. Strategies such as gifting, establishing trusts, and utilizing exemptions may seem straightforward at first glance, but the nuances and regulations governing each approach demand careful consideration and expert guidance. Furthermore, the threshold for inheritance tax varies across jurisdictions, adding another layer of complexity to the equation. In this intricate web of legal and financial intricacies, consulting a professional advisor becomes not just advisable but imperative. Estate planning professionals possess the knowledge and expertise to navigate the maze of tax regulations, crafting personalized strategies that maximize tax efficiency while ensuring compliance with the law. In the realm of inheritance tax, the guidance of a seasoned professional can spell the difference between preserving wealth for generations to come and unwittingly falling afoul of tax authorities. That's all for this video. If you found this video of interest, please give me a thumbs up and subscribe. I welcome any comments or thoughts you can share with others on the topic down below. Remember to consult an accredited professional for specialist advice before making financial, legal, or any other retirement-related decisions requiring expertise. This channel simply shares publicly available information in the UK which you use at your own risk. If you are approached by somebody with exotic-sounding investments and impossibly sounding good returns, you may be about to be duped by a scammer. Always do your research. Stay safe, stay smart. Until next time.